Welcome back to the deep dive. Today we're tackling something that's, well, really buzzing right now. We're looking at XRP, this idea of a potential supply shock. And honestly, these reports hinting at moves by giants like BlackRock and JPMorgan, that got my attention. These aren't small players. What's really going on here? Are we seeing something genuinely significant starting to unfold? Because, the idea that these huge financial institutions might be quietly making strategic plays in XRP, well, if that's true, it could really change the game. Not just for XRP, but for how traditional finance sees Web3 overall. This feels bigger than just market charts. It feels like that convergence point we keep talking about. Traditional finance meets digital assets. I'm really keen to dig into what this all could mean.
Yeah, you're right. The stakes feel pretty high with this one. So our mission today is really to unpack all of this, the reports, the speculation, all of it. We need to get clear on what supply shock actually means for something like XRP. You hear the term thrown around, but what are the mechanics? And then, why would these big players, BlackRock, JPMorgan, even look at XRP? What's the thinking there, especially after, the recent legal stuff? And finally, what are the ripple effects for investors, for traders, for the whole Web3 space? We really want to kind of sift through the hype and find the potential reality underneath, give you a solid perspective.
That's exactly what's needed. Okay, and before we dive right into whether this XRP supply shock could be, the defining altcoin story this cycle, just a quick thing. If you're finding this deep dive useful, if you like what we're doing here, please do hit that like button, subscribe to the channel, maybe click the notification bell. Seriously, your engagements, the likes, the comments, even sharing it makes a huge difference. It tells the algorithms, hey, this is good stuff. It boosts visibility, helps us grow. And honestly, it lets us keep making this kind of in-depth content for you. It's really crucial. Okay, with that said, let's unpack this XRP situation. So let's just cut right to it. This central idea. XRP might be facing a supply shock. It sounds dramatic, right? Like something big is about to break. But in crypto terms, what does that actually mean? How would we see it?
It does sound dramatic, and honestly, sometimes it is. So for a digital asset like XRP, a supply shock is basically when the amount available to trade easily on exchanges, the liquidity, it just drops off significantly, and sometimes pretty fast. Imagine like a store suddenly running out of the one thing everyone wants. If demand stays high or even goes up, boom, you see these sharp, sudden price jumps, often exponential. It's basic supply and demand, but amplified. And it's especially potent in crypto because these markets move so fast. Unlike, say, the stock market with circuit breakers, crypto can see these massive shifts in supply and demand happen almost instantly. The price changes can be way more extreme. It's not a slow creep. It's like a vacuum sucking up supply against rising demand. Can get explosive. Okay, so what's driving this for XRP specifically? There seem to be a few key things lining up. First, and this is probably the biggest one, is growing institutional demand. And we're not talking about, your average person buying some XRP. We mean big players, hedge funds, asset managers, maybe even companies, people with very deep pockets. When they buy big, millions, maybe hundreds of millions of dollars worth. And crucially, they often aren't just trading it, they're holding it long-term, strategic positions. So that XRP gets pulled out of the active trading supply on exchanges. It's like locking up shares in a private vault, just gone from the day-to-day market. Second factor, Ripple's own escrow system. This is pretty unique to XRP. Ripple holds a huge amount of XRP in these locked escrow accounts, billions of them. Every month, 1 billion XRP gets released. And this is key, a lot of that doesn't just flood the market. Ripple often puts a large chunk right back into new escrows or uses it for partnerships, things like that. So it controls the flow of new supply hitting the open market. It's not a fire hose. It's more like a carefully managed tap. Anyone following XRP really needs to watch the monthly escrow release data and, the re-escrow amounts. Plus, transaction fees on the XRP ledger are burned permanently destroyed. It's a small amount usually, but it adds to that scarcity pressure over time. So you've got this controlled release, some getting put back, and a tiny bit getting burned. It's a very deliberate supply mechanism. And the third piece is XRP's actual use, its utility. In cross-border payments, settlements, this is what it was built for, right? Speed, low cost. As more banks, payment companies, whoever, start using RippleNet, that's Ripple's payment network, and using XRP for these instant global payments, that XRP is being actively used. It's like working capital for them. Think of a bank needing XRP to zap money across borders in seconds instead of days. That XRP isn't sitting on Binance waiting to be traded. It's doing a job. It's tied up in the system. And that operational demand, that pulls more supply out of the speculative pool. It tightens the screws even further.
Okay, wow. So you have institutional buying, controlled releases, and actual operational use, all potentially squeezing the available supply, right? Here's where it gets really interesting for me. If this plays out, what does it actually look like in the market for someone watching the charts, trying to trade What are the immediate effects? It sounds like things could get wild.
Oh, potentially very wild. Yeah, the market dynamics would shift pretty dramatically, and you'd see it quite quickly. The biggest thing would be what we call order book thinness. With less XRP easily available on exchanges, the order books, the lists of buy and sell orders at different prices, they get shallow, really shallow. Instead of seeing lots of orders stacked up, you might see just a few here and there, like gaps. So even a medium-sized buy or sell order can suddenly push the price a lot because there just isn't enough opposing supply or demand right there to absorb it. And that thinness, that directly fuels volatility big time. When the books are thin, even fairly small trades can cause these huge price swings. A decent buy order could just chew through the few sell orders available and send the price rocketing up, price discovery they call it. But equally, a decent sell order could knock it down just as fast. So yeah, traders would need to brace for much faster, much sharper moves. It's like navigating choppy waters. And then that volatility and thinness often opens up more arbitrage opportunities. When prices move fast and liquidity is patchy across different exchanges, you get these temporary price differences. Like XRP might be a tiny bit cheaper on exchange A than exchange B for a split second. Smart traders, usually using bots, jump on those differences. Buy low here, sell high there, instantly. A supply shock would likely make those gaps appear more often and maybe be a bit wider. So more chances for arbitragers if they're quick. High-speed game, though. You can sometimes visualize this with things like liquidity heat maps. These tools show where the big blocks of buy and sell orders are sitting. In a supply shock, you'd expect to see big cold spots on those maps areas with hardly any orders, where the price could just jump across huge gaps. It really highlights where the market is most fragile, most prone to sudden moves.
That paints a very vivid picture. Thin books, big swings, arbitrage. So the big question hangs there, will this potential supply shock actually send XRP to new all-time highs? Or is it, maybe getting overhyped? It's definitely something to think about as we go deeper.
The mechanics sound right for a big move, but execution is everything. And that leads us perfectly into the next massive element here. These reports, these rumors about BlackRock and JPMorgan. I mean, seriously, these are the absolute titans of traditional finance. What are people saying? How might they actually be getting involved with XRP?
Yeah, those names definitely make you sit up and listen, don't they? And that's why any whisper about them touching crypto, especially something like XRP, just explodes. Now, we have to be super clear up front. A lot of this is still speculation, rumors, stuff circulating online. Official confirmation from these institutions, that's usually rare, especially early on. They like to move quietly, test the waters. But, and this is a big but, the sheer weight of these names means you can't just dismiss it. BlackRock is the world's largest asset manager. JPMorgan is, well, JPMorgan. If they're even seriously considering XRP, that's a massive signal. It speaks volumes about shifting perceptions. So how might they be involved? The talk points to a few sophisticated methods, not just buying on Coinbase. One big area is custody solutions. This means these firms or companies they work with providing super secure institutional-grade storage for XRP. Think digital vaults, highly regulated, audited for their big clients, hedge funds, family offices, other institutions. When a BlackRock or a JPMorgan offers custody for an asset, it's like a stamp of legitimacy. It tells their clients, this is serious, we can handle this professionally. That's a huge step. Then there's all the talk around ETF-like structures. We all saw the Bitcoin ETFs, right? Especially BlackRock's IBIT just hoovered up billions unbelievably fast.
It's incredible speed, yeah.
Totally. And now we're seeing movement on Ether ETFs. So there's a clear playbook. Maybe not a direct XRP spot ETF tomorrow, but they could be looking at similar ways to package XRP for their clients, maybe through private funds, maybe complex derivatives, maybe baskets of digital assets, where XRP is a key piece. It's about creating those regulated, familiar wrappers that traditional investors understand and trust. And that links to the idea of private funds or OTC deals. Institutions often don't buy massive amounts on public exchanges that would move the price too much and alert everyone. These private funds, dedicated institutional vehicles, or over-the-counter desks to do big block trades quietly. This is that quiet accumulation people talk about. And it's exactly what researchers try to spot using on-chain analysis, looking for those whale accumulation patterns.
Right.
Seeing big chunks of XRP moving off exchanges into new, large wallets, clusters of activity that suggest coordinated institutional buying. It's like detective work.
Okay, so that covers the how custody, ETFs, private buys. Very institutional, very strategic. But the big question remains, why XRP? Out of all the digital assets, all the traditional assets, what's the specific appeal for these giants?
That really is the core question, isn't it? And it seems to come down to XRP's potential role in the future plumbing of finance. One huge factor is its design for cross-border payments and settlement. Let's be honest. The old way of sending money internationally, correspondent banks, swift messages, it's often slow, expensive, and clunky.
Painfully slow sometimes.
Right. Takes days, costs a fortune in fees, ties up capital in pre-funded accounts. XRP promises near instant settlement, like 3 to 5 seconds, and the transaction fees are tiny, fractions of a cent. For institutions moving billions across borders daily, the potential savings in time, cost, and counterparty risk are just enormous. It's not just incremental improvement, it's potentially revolutionary. XRP acts like that neutral, super-fast bridge currency. And secondly, there's its potential as a bridge asset for tokenized finance, especially real-world assets, RWA.
Okay, RWA again. So tokenizing things like real estate, bonds.
Exactly. Bringing traditional assets onto the blockchain, it's a massive trend, promising more liquidity, fractional ownership, global access. But you need a way to efficiently move value between these different tokenized assets or between them and regular money. You need a fast, cheap, reliable intermediary. And XRP is really well positioned for that. It could be the bridge that connects tokenized real estate on one chain to the tokenized commodities on another, or to fiat seamlessly, like a universal translator for value. And honestly, a huge catalyst here, we can't stress this enough, was the Ripple SEC lawsuit outcome.
Ah, yes, the big court ruling.
Absolutely fundamental. That ruling in the U.S. saying XRP itself isn't a security when sold on secondary markets, that just blew open the doors for U.S. institutions. Before that, the regulatory uncertainty was a massive deterrent. Compliance departments were saying, no way, too risky. Getting that clarity, even if just in the U.S. for now, made XRP a much, much safer asset for these big conservative firms to actually engage with. It dramatically changed the risk assessment.
That legal clarity really does seem like a watershed moment. It took away a huge piece of the uncertainty. So putting it all together, do you think BlackRock and JPMorgan are really accumulating XRP? Or is this just, hopeful chatter, smoke and mirrors? It feels like a massive fork in the road, depending on the answer. Huge implications either way.
It is a massive question. And honestly, separating the signal from the noise is tough. But if we look at historical parallels, like the price reaction to ETF or custody news for Bitcoin and Ether, it gives us a pretty good clue about how markets tend to react to genuine institutional moves. When credible news breaks or even strong, well-sourced rumors surface about a player like BlackRock launching a product, we usually see significant positive price action.
We definitely saw that with the Bitcoin ETFs.
Exactly. It's not just retail FOMO, it signals legitimacy, anticipates huge inflows of new money. So that history provides a kind of template. If similar concrete news about XRP and these institutions emerges, we have a basis for expecting how the market might react. It tends to react strongly to these signals.
That's a really useful framework. Okay, let's pivot now and bring this right down to the listener. So what does all this, the potential supply shock, the institutional whispers, what does it actually mean for you? How does it impact different folks in crypto? The long-term holder, the active trader, someone just watching the ecosystem evolve.
Right, this is where it gets personal. And the impacts are quite different. For investors, especially if you got in early or are holding for the long term, well, if this supply shock driven by institutional demand actually happens, you could see disproportionate benefits. And by that, I mean it's not just a simple price increase. When you have real scarcity hitting serious, large-scale demand, the price action can become exponential, not linear. Think about like a rare vintage car. Suddenly, a bunch of new billionaire collectors want one. The price doesn't just edge up, it can go parabolic because the supply is fixed and tiny relative to the new demand. Early XRP holders could find themselves in a very advantageous position if institutions truly start accumulating and using XRP at scale. It's that classic scarcity play, potentially amplified. Now, for traders, it's a totally different ballgame. More like a high wire act. As we said, a supply shock likely means way more volatility, those thin order books, more arbitrage chances. Now, that's obviously risky. Big swings can wipe you out fast if you're on the wrong side.
High risk, high reward territory.
Exactly. But for skilled traders, those who thrive on volatility, have fast execution, maybe use algorithms, and are great at spotting those quick price differences across exchanges, it could be a gold mine. Fertile ground for capitalizing on rapid moves and market inefficiencies. It demands serious skill, discipline, good risk management. But yeah, the potential for profit in that kind of environment is significant for the prepared trader. And then, looking at the bigger picture, for the whole Web3 ecosystem, this could be transformative. If XRP genuinely transitions from, what some people saw as a controversial token because of its history, to being seen as a core piece of institutional plumbing, a respected backbone for settlement, That's huge. It lends massive credibility not just to XRP, but to the entire digital asset space. It shows traditional finance isn't just speculating on Bitcoin or funding DeFi experiments on Ethereum. It's actually integrating this tech for core operational efficiency. That kind of validation could accelerate broader adoption across the board. It makes the whole space look more mature, more inevitable. What's really cool here, I think, is stepping back and seeing it's not just about XRP's price. It really highlights this accelerating convergence. Old money meets new tech. It shows that real utility, solving real problems like slow cross-border payments, is driving adoption even in the most established corners of finance. The vision of a faster, cheaper, more connected global financial system, it feels like it's actually starting to happen.
That's a great perspective. Tying it back to that bigger convergence theme, it definitely makes you think. What stands out to you listening to this, these different impacts from individual wallets to the entire ecosystem? It feels really significant. Okay, let's zoom out a bit further then. Thinking long-term, strategically, how does RippleNet fit into this picture? Ripple's payment network, how important is that for XRP's future role?
Oh, RippleNet is absolutely crucial. It's the engine that actually uses XRP for its intended purpose, its ongoing adoption by banks, payment providers worldwide. That's the bedrock of XRP's utility claim. RippleNet is the infrastructure designed to leverage XRP for those fast, cheap, international payments we talked about. So the institutions using RippleNet aren't just speculating on XRP, they're using it. It's the fuel for their cross-border transactions via on-demand liquidity, or ODL. Every new bank or payment firm that plugs into RippleNet and uses ODL reinforces that real-world demand and utility. It proves the concept works and is being adopted. And this ties back directly to scarcity, but in a really interesting way. If institutions start holding large amounts of XRP, not just as an investment, but as operational liquidity.
Meaning they need it on hand to actually make payments.
Exactly. Like working capital. They need a stash of XRP ready to go to facilitate their clients' transfers instantly. That XRP isn't just sitting passively in a cold wallet. It's actively required for day-to-day operations. It's being constantly used and replenished. This operational lockup makes the effective circulating supply even tighter than just considering the escrow releases. It's demand driven by fundamental business needs, which is often much stickier, much more sustained than purely speculative demand. It creates a deeper layer of scarcity. And this really solidifies XRP's potential role as that bridge asset we mentioned, connecting different parts of the future financial system. Think about CBDCs, central bank digital currencies. Every country might have its own. How do they talk to each other?
Good question. Interoperability seems key.
Right. And XRP could be that neutral fast bridge, a way for a digital euro to settle instantly with the digital yen without complex bilateral setups, a common settlement layer. Same thing for stablecoins. You've got USDT, USDC, maybe regional ones, future bank issued ones, all potentially on different chains. XRP could be the rail to swap between them quickly and cheaply, moving value from USDC on one network to a euro stablecoin on another almost instantly, reducing friction. And then back to RWA tokenized assets. Imagine wanting to swap tokenized real estate for tokenized gold. XRP could be the intermediate settlement asset that makes that swap happen atomically, efficiently, across different systems, connecting digital assets back to fiat easily. It becomes that crucial glue, that value transfer protocol for this emerging tokenized economy.
Wow, okay. That vision of XRP is the universal bridge, connecting CBDCs, stablecoins, RWAs. That's pretty powerful. It's an ambitious role. So the question then becomes, is it really positioned to be that bridge asset of the future? Is this the convergence point? Or is it, still fundamentally a speculative asset with a really good story attached? That feels like the core tension here.
Mm-hmm.
And speaking of tension, with all this potential, we absolutely have to talk about the risks. Because nothing this potentially big comes without challenges. It's crucial to keep our feet on the ground. So what are the potential pitfalls? What could go wrong here?
Absolutely essential to cover the risks. And there are definitely significant ones. First off, regulatory uncertainty isn't completely gone, despite the U.S. win. That was huge, yes, but mainly for secondary market sales in the U.S.
Right. The rest of the world is still a question mark.
Exactly. How will Europe classify it? What about major Asian markets, the UK? Different countries might come up with different rules, different compliance burdens. That global patchwork could still slow down widespread international institutional adoption. Institutions hate regulatory ambiguity, so lack of global clarity remains a hurdle. Second, the risk of overhype is very real. We talked about institutional interest, but is it deep commitment yet, or just kicking the tires?
Testing versus allocating billions. Big difference.
Huge difference. Institutions often run pilots, do extensive research, small tests. That's not the same as fully integrating XRP into their core systems or putting massive capital behind it. There's a danger that the current buzz runs way ahead of the actual pace of integration. If that happens, the supply shock narrative might fizzle or be much less dramatic than hyped. We need to watch for real confirmed adoption, not just exploratory steps. And third, you always have market manipulation risk, especially around rumors.
Ah, yes, the classic crypto pump and dump.
Precisely. Unconfirmed news, especially about things like ETFs or big custody deals, is prime bait. Bad actors can easily spread rumors, use bots to amplify them on social media, create FOMO, all to artificially inflate the price so they can dump their bags on unsuspecting retail investors. It happens all the time. So extreme skepticism towards unverified news is essential. Always check sources. Understand who benefits from spreading a rumor. So it really comes down to this critical question for anyone watching this space. How do you tell the difference between genuine, solid, long-term institutional integration, the kind that builds real value, and just short-term, rumor-fueled speculative hype? It takes critical thinking, focusing on verifiable data, looking beyond the headlines. It's about substance over noise.
It's such a crucial point. Vigilance and critical analysis are key. Okay, so to help us separate that signal from the noise, maybe looking at some history and specific data points could help. Ground this a bit more. Are there parallels or metrics we can actually track?
Definitely. History might not repeat, but it often gives clues. And data helps anchor us. Look at the Bitcoin ETF launches, especially BlackRock's IB.
We mentioned its speed earlier.
Right. The sheer volume of inflows, how quickly it absorbed Bitcoin's supply, that showed just how impactful real committed institutional products can be. It wasn't gradual. It was a floodgate opening. That's a benchmark for institutional impact. Then the Ethereum ETF approvals. Why were they important? Because they showed institutional interest wasn't just about Bitcoin. It signaled a broadening acceptance. They're looking at other major assets with strong ecosystems and utility. That opens the door mentally for things like XRP. And again, Ripple's SEC win. We keep coming back to it because it was that pivotal. It wasn't just legal. It removed a psychological and compliance barrier for U.S. firms. It made XRP investable for many who couldn't touch it before. It unlocked potential demand. Also, think about MicroStrategy's Bitcoin strategy.
Michael Saylor's company, right? Buying huge amounts.
Exactly. It's a real-world case study of corporate accumulation, one company deciding to hold massive amounts of a digital asset long-term. It shows how corporate treasury decisions, even by one major player, can significantly impact circulating supply and market perception. Imagine if more companies did that. And finally, remember Grayscale used to have an XRP trust. It's not active now, but its existence proves institutional interest in XRP isn't brand new. They were looking for ways to get exposure years ago. Provides context for the current buzz. Okay, so beyond history, what can you track now? Specific metrics. One is XRP exchange reserves. How much XRP is sitting on exchanges, ready to be traded. If that number consistently goes down, it usually means coins are moving to private wallets, cold storage, likely for long-term holding. That suggests supply is tightening. Analytics sites track this. 2, keep watching the escrow release and burn data. Monitor Ripple's monthly reports. Is the newly released supply being quickly absorbed or re-escrowed, or is it piling up on exchanges? That tells you about the supply-demand balance directly from the source. 3, whale accumulation patterns. Use on-chain tools if you can. Look for large, sustained movements of XRP off exchanges into new or known large wallets, clusters of buying activity. That can signal quiet institutional accumulation. And 4, observe the price reaction if any credible ETF or custody news actually breaks for XRP. Compare it to Bitcoin Ether reactions. Is it a quick spike and dump or sustained buying with strong volume? The market's reaction itself is a data point about conviction.
Okay, that's incredibly helpful. Real history, real data points to watch. It moves beyond just speculation and gives people concrete things to look for. It empowers listeners to do their own homework, which is what we always encourage. All right, so as we bring this deep dive to a close, it feels like we've covered a lot of ground on a really compelling story. We've got this idea of an XRP supply shock, potentially driven by its core utility, and maybe amplified by interest from huge names like BlackRock and JPMorgan, even that's still developing. And we've explored XRP's potential future as this strategic bridge asset sitting right at that crossroads of TradFi and DeFi, solving real problems.
Precisely. And maybe just one final thought to leave everyone with, something to chew on. If, and it's still an if, but if these massive traditional institutions are genuinely starting to integrate assets like XRP into the fundamental infrastructure of global finance, what does that ultimately signal about the future of money itself, about how value moves around the planet? And maybe more profoundly, what does it mean for the original decentralized ideals of crypto? How do these powerful centralized players reshape the landscape as they enter? Does it change the balance of power, control, access? It's not just about price. It's about the potential transformation of the entire financial system and what that integration really looks like in practice. That's a future worth thinking deeply about.
A future definitely worth thinking about, and one we'll no doubt continue to track right here on the Deep Dive. Thank you so much for joining us today as we navigated this complex intersection of digital assets and traditional finance. Really fascinating stuff. We'll catch you on the next one.